Hi friends. Just in recent days here in Myrtle Beach, where our office is located, we endured parts of Hurricane Ian. And one of the things I appreciate about certain meteorologists, particularly in the area, is they give it to you direct. They don't try to monkey around or sugarcoat anything. They give it to you straight with no chaser. And so part of being a fiduciary and giving advice to families across the country, my responsibility, our team's responsibility, is to do the exact same, to give it to you as we see the data. And I want to be clear, we are dangerously close to the Federal Reserve inducing a recession. Now, let's back up for a moment and be clear on a couple of things. Number one, we are not in a recession right now. Number two is the economic data is anti-recessionary. But number three, there gets to a point where you can't fight the Fed. And as we said in previous videos, this Federal Reserve fundamentally does not understand what will tame inflation. Now, I've had this conversation with many of you in private, but I'd like to have it again for a moment. In 2020, when the Federal Reserve injected $5 trillion into the system that, by the way, we didn't need, to sort of, as they see it, help ease the pandemic, the economy was strong enough, corporate America was resilient enough, we could have done without it. But nonetheless, they injected $5 trillion of liquidity in the form of stimulus payments and PPP loans and ERC credits, et cetera, et cetera. The natural effect is that inflation and interest rates begin to rise. It's a cause and effect. Liquidity increases, the money supply increases, interest rate and inflation does. But with their right hand, the Federal Reserve injected the $5 trillion, and with their left hand, they artificially held down interest rates and inflation. That broke the primary tool that the Federal Reserve has had at their disposal for decades to manage inflation. So what we're seeing now, because the Fed tried to come out and tell us at the beginning, it's just transitory. It's just here, but it's going. It's simply not true. And if you've watched the Federal Reserve's actions while they continue to raise rates at an aggressive and alarmingly hawkish or pointed rate, and yet inflation is still raging, it's because they are trying to fight inflation with a broken tool. And we've got the playbook from the Paul Volcker days in the late 70s and early 80s. Let interest rates run where they may, and let capital markets determine where those interest rates are, and inflation is fought by managing the money supply. So, let me give you an analogy that I think makes this very clear as to how interest rates and the Federal Reserve being so aggressive affects the stock market both now and in the future. If you owned a rental property and you had X amount of cash flow from that rental property, and then your banker came to you every month and raised your debt service or your interest rate on that investment home every month, what it starts to do is to diminish your cash flow. And so as your debt increases by interest rates going up, the value or the free cash flow you have goes down. Take that same principle and apply it to markets. As the Federal Reserve continues to raise rates, it is devaluing the S&P 500 because the S&P 500 is valued on its forward-looking profits. What will companies make in the future, not what have they made in the past. So because the Federal Reserve has raised rates so aggressively, we sit at the making of this video with roughly around a 3,600 valuation and around a 3,650 actual market price, meaning at these rates, the market is fairly valued. But if the Federal Reserve continues over the next 2, 3, 4 meetings to raise rates at the same pace that they have, what that does is it devalues the market. And so to be very clear, what we're saying is unless the Federal Reserve has a fundamental shift in action, the market has more room to fall. And at some point in early to mid 2023, if the Federal Reserve keeps their actions, they will in fact induce a recession. Now, part of our responsibility is to say, how do we manage the moment? If we're walking outside and it is pouring rain, we're not going to stay dry. But what we can do is minimize the amount of rain and wetness that we experience, and we call that risk management, loss aversion, asset protection, because we believe in this volatile, forward-looking, uncertain market environment. And as we watch the Federal Reserve closely, your best growth strategy is a protection strategy. And I can't tell you how many families over the last 3 and 6 weeks that I've sat in front of whose financial advisors or stockbrokers are just pushing product or the same narrative that's existed the last 8 to 10 years. And folks, it simply will not work. There is a new sheriff in town, and you have to have a fundamentally and radically different approach to managing the risk in your portfolio than you've ever had in the last 10 to 12 years. Now, fortunately for families that we serve around the country, we've already been doing this. And as we've had our end-of-year tax planning meetings, we're showing exactly how that's benefited you. But know, with an uncertainty, as we called it in our last video, no man's land, as we watch with bated breath the Federal Reserve's actions over the next 2, 3, and 4 meetings, they will ultimately determine if they could find a way to throttle down and allow capital markets and economics to accelerate. Then we'll begin to see the makings of a recovery that may take 9 to 12 months. But if they continue to act the way that they have, then they're going to crash the economy into recession, and we're going to have a 12 to 24 month recovery. And so what all of this means is we are driving up yields, right? If we're going to be lower for longer, we want to receive that, and we are increasing our already strong positions in inflation participating assets and risk management. We will get through this together, but you need to know that if the Federal Reserve doesn't reverse course, the majority of the pain is in front of us and might not be behind us in certain areas of the market. Rest assured, we've been thinking about this for some time. We are prepared for whether the market is ready to recover or whether the Federal Reserve takes us towards recession. And just know that in our conversations, we have taken in your individual risk. We have had those planning and risk management conversations, and that we will recover. We will get through this. But the Federal Reserve will determine whether it's a long winter or a short winter. Stay tuned, watch their actions as we are, and we'll keep giving it to you straight with no chaser. Thanks for watching. See you next time.